Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London sugar markets. I'll start with ICE raw sugar in New York. Okay, headache time again. Fourth week in a row, and I again must apologize for the multitude of lines and labels that I've drawn on this daily chart. However, technically there's still a lot going on here, and these labels and lines are all valid in my deciphering and trying to decipher what is happening here. Okay, so I have to go back to the declines earlier this year below the long moving average, currently 1921. They are the result of three head and shoulders patterns created between August 21 and January 22. I've already exhaustively highlighted all three of these patterns, so I will not go any further into detail other than to say they're complex versions of normal workaday patterns. However, there's one interesting point to discuss: the neckline of the October 21 to January 22 head and shoulders top, plus the middle time, after a fashion, currently at 1901, and managed to stop the decline back at the end of February. The subsequent recovery back up was prompted by an immediate countering weekly key reversal up over the turn of February into March. This recovery rose up to the neckline of the older August to November 21 complex triple top, currently at 2026, breaching it, breaking it even, before the rally failed in mid-April, and we've seen prices drop thereafter, gapping lower even until 3 weeks ago. Please keep in mind that neckline of the August to November 21 complex triple top as it pops up again. Anyway, the massive congestion support around the middle time, mainly the combination of the February 21 high at 1894, the medium moving average currently 1896, the long moving average currently 1921, and the short medium moving average currently 1939. Well, they all eroded the bearishness over the start of May until the middle of May, such that though prices pushed below all of them, the market did not have the sufficient or further impetus to aggressively push lower below the congestion from February this year. That's between approximately 1840 to 18 even. Within which, notably, sits the 50% absolute Fibonacci line for the 21st century at 1809. Thus, 4 Fridays ago, the first bullish shots were fired with a daily key reversal up, which was halted in its rise by the same congestion of moving averages topside. This rise actually did a lot to fill in the change gap earlier in the month, but it was still an open gap, still is an open gap even now. Then 3 Thursdays ago, the market made an immediate countering bullish engulfing pattern that was the start of a strong move higher, which only halted 2 weeks ago by our old friend the neckline of the August to November 21 complex triple top, currently 2026, aided and abetted by the middle time, currently 2032, of the newly drawn start of March to mid-May bullish Andrews pitchfork. All this action also created some may say, artificially an island bottom over the first 2 weeks of May. The target of such an island bottom was reached 2 weeks ago. Thus, prices have risen up to an area of resistance that currently stretches from 2010 to 2100. This is not a new area. No, you can see a box in the upper left of the corner of the daily chart that I wrote. Well, I can't actually remember when I wrote it, but it details a specific band from January to February 2017 just on this daily chart. This area has capped the market back in October and November 21, then again recently in April this year. In no particular order, we have resistances at 2012, 2034, 2047, 2070, 2076, and 2100, as well as the complex neckline from August to November 2021. All these have been and are rubbing compounds to erode the bullish incentive which was so brilliantly shown over the past 2 weeks, but in an area fairly empty of significant resistances or supports. Hence, we have this past week seen bearish pressure being brought from above as prices have reached up to a level in which they may be confidently applied. We're now back to testing supports, and I suspect the most significant one may well turn out to be the newest, and that's the bullish Andrews pitchfork. But between there and where we are now, we have a lot of supports from all the moving averages and the middle time of December 20, April 21 bullish shift pitchfork. And they may stop it, or at least erode the very recent bearish incentive. ICE Europe white sugar in London. Okay, so let's cover some of the groundwork. You see, this market made a big meal from the break upwards out of the September 21 to February 22 lopsided diamond pattern back in February. The move up took its own time, but by mid-April the market reached up to the 572.20 area, the target for the mid-February, mid-April bullish half hesitation. Since then, we've had a changeover gap lower, and prices have pulled back to the vicinity of the congestion from early 2017 in the 517.80 area. This area is actually a complex support zone. It also includes the neckline from August to December 21 complex head and shoulders top, currently at 523.30, as well as the important rising medium moving average, currently 523.5, and the rising long moving average, currently 512.90, that's just below. This is why recently, for 3 weeks, prices held over and around the 517.80 area, more or less, and under the old gap from March 2017 between 531.70 to 532.70. 3 weeks ago, I posed the question, what does this period of intraday indecision, what does it signify? Does it signify a bottom, with prices moving back up to the May 2017 high resistance at 548.70? Does it signify a halfway hesitation, with prices tripping below all the moving averages, as well as the congestion area 488.10 to 490.10? Well, the answer came during the same week, when the market made a weekly key reversal up, which included a gapping move higher. Since then, prices have stabilized over the March 2017 high at 548.70 and corralled on the top side by the middle time, currently at 571.10 of the newly drawn February to May bullish Andrews pitchfork. Late last week, the market made an unusual key reversal up on a prior bullish pattern that pushed up over the next resistance, the February 2017 high of 565 even, thus filling in the changeover gap between 554 even and 572.5. Today, with no New York contract available to trade, prices went even higher, over the middle time and up to challenge the April high at 577.60. Beyond that, well, the next obvious level on the top side is the November 2016 high of 590 even. But it will very much depends on whether the market regards the action over the last 3 weeks is it a bullish half hesitation, in which case prices could go up to 600. But it is still early on that. Yet I will point out one thing. Prices push over 577.60 between now and Tuesday night, which is possible, and then close on Tuesday night over 541.5, which would be doable, then we would have a very large monthly key reversal up for May. Sugar white premium, the spread. I said 2 weeks ago that this spread market speaks volumes as to the state of the current New York market and London markets, both individually and collectively. I was, of course, referring to the 3 weeks between 25th of April and the 13th of May, where we had one indecisive spinning top and 2 consecutive indecisive doji crosses, all in a row. All this came as the market was trying to make sense of a false break higher over March and April from an ascending wedge pattern formed between July 21 and the middle stroke late part of May. It was a reasonably good looking pattern, and I would not normally expect problems from such an action. However, problems are what it has given as the lower trend line, which is the mid-August 2021 to April broken uptrend, currently at 127.25, and the upper trend line, currently 123.75, bisected the uptrend 3 weeks ago. And as we ran out of space in this ascending wedge pattern, there are 2 further patterns, one of which I've previously drawn your attention to, which still need to be discussed. The first is the quiet and subtle bullish bow tie formation formed over Christmas last year, made from the short moving average, currently at 121.25, short medium moving average, currently 116 even, and the long moving average, currently 82.75. What had been interesting back at the time of its formation was how all the moving averages went in and out of the bow tie in the right order, a rare feat in some markets. Theoretically, the market should move in the direction of the outgoing moving averages, in this case higher, which we have already seen. However, the key move should happen between 15 to 20 trading sessions after the crossover. In this case, it would be between the 4th of April and the 9th of May this year, or in other words, 3 weeks ago. This may go to explain why, after the sharp curtailing of 3 weeks of indecisive patterns, we've had 3 weeks now of bullish patterns, initially gently moving the market higher, and then last week explosively moving the market higher. The key discussion point I've already spoken about last week, but it's still worth a revisit. You see, 3 weeks ago, the market had a weekly key reversal up, and this formed the next phase of its actions. Or as I put it last week, and I quote, wrenching victory from the jaws of defeat by just one action, end of quote. Finally, there is one more pattern I would like to discuss ever so briefly. I'd previously spoken about it this way, and I quote, there is a pattern which, whilst not directly touched, may be indicative of the bullish angle of attack. It is the 2019-2021 bullish Andrews pitchfork. The market is currently in between the middle time overhead, currently 136 and a quarter, and the lower time below, currently 62 even. I further added, that was the end of the quote, and I further added, and I quote, the upper trend line of the ascending triangle runs approximately parallel to the middle time, and that is also something to watch, end of quote. This bullish Andrews pitchfork is still operational, as provided with its middle time the next major obstacle, not only in March and April, but last week. This is where I wish to discuss last week's actions. It was a major move higher that punched up through up through the high of 2 years ago in June 2020 and closed over it on Friday, though not over the middle time. That breaking of the rising middle time will be the next real bullish goal. However, I feel obliged to label some potential targets now on the top side for this ascending wedge pattern, which has had false breaks both above and below, and even though prices are still below the middle time. Hence, an initial target X would be in, wait for it, in the 162 even area. Yes, well up and off the top of my daily chart. Secondary harder to achieve target X1 would be in the 191.5 area. I know that these are humongously big asks, but that is what I see. It depends on one thing and one thing only: that prices maintain contact with the middle time or break upwards, clear of it. If prices choose to turn back down, as they did back in March and April, then we still have the bullish incentive, but may open the way for a possible double top formation and other bearish patterns. I'll finish with the words of 2 weeks ago, and I quote, maybe, just maybe, we are seeing the beginnings of a new or further move here, end of quote. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.